Because Iran mined the Strait of Hormuz, American homeowners are now paying more for their mortgages than at any point since October 2025. The mechanism runs through Treasury yields, with 20 million barrels of oil per day, roughly 20% of global supply, effectively bottled up in the Persian Gulf. Oil prices surged back to $105 a barrel on the Brent benchmark, after briefly dipping below $100 on peace talk rumors. Elevated oil prices force bond markets to reprice inflation expectations upward, and since the 30-year fixed mortgage rate is benchmarked directly to the 10-year Treasury note, the transmission is mechanical. The 10-year Treasury climbed from 3.96% before the war to 4.39%, pulling the 30-year mortgage rate up to 6.43%, more than 30 basis points higher than at the end of last month. Oxford Economics calculates that the shock hits hardest in southern and midwestern metros, where households already spend 16% of their budgets on groceries, fuel and utilities. The three categories hit fastest by energy-driven inflation. For those households, the war in the Gulf is not a foreign affairs story. It is a budget crisis arriving in real time. The same oil shock that is tightening household budgets is now forcing a dilemma onto the Federal Reserve that economists have not faced in decades. Higher oil prices push headline inflation upward, which would normally call for rate hikes. But the Iran conflict is simultaneously dampening growth. Oxford Economics has already lowered its GDP growth forecast from 2.8% to 2.4%, and consumer spending growth is now projected at just 1.9% for the year. Legendary investor Mohammed El-Erian has warned publicly that the economic impacts are approaching a tipping point, the threshold where supply shock inflation meets demand destruction, producing the stagflation mix that the Fed's standard toolkit cannot address cleanly. Wolfe Research chief economist Stephanie Roth estimated that food-at-home inflation alone could rise by 2 percentage points, while Britain's Institute of Grocery Distribution projected UK food inflation climbing from 3.6% to over 8% by June, a signal that the price pressure is not contained to American shores. The Fed cannot cut rates to protect growth without risking entrenched inflation, and it cannot raise rates to control prices without tipping a slowing economy into recession. Retail investors have already begun responding. Data shows a measurable shift toward defensive option strategies in the weeks surrounding the Iran conflict, a behavioral signal that professional and amateur market participants alike are pricing in sustained uncertainty rather than a clean resolution. Meanwhile, a different mechanism has been running quietly in the background, one that predates the war but is now being accelerated by it. The wealthiest 0.1% of U.S. households hold roughly a quarter of all domestic equities, according to Federal Reserve data, which means every surge in equity valuations, even volatility-driven relief rallies, flows disproportionately upward. When Trump's announcement of peace talks sparked a $1.7 trillion single-day equity rally, that gain was not distributed evenly. An Oxfam America analysis of New York State found that the top 10 billionaires gained $42.4 billion over the past year, an average of $2 million per hour, while real average hourly earnings for the state's private sector workers stagnated below pre-pandemic levels. The Trump administration's One Big Beautiful Bill, passed last July, is expected to cut the tax burden of the top 0.1% by $311,000 per household by 2027, while simultaneously raising costs for households earning under $15,000. Moody's chief economist Mark Zandi has described lower-income households as hanging on by their fingertips financially. The war-driven oil shock, which disproportionately punishes spending on fuel, food, and utilities, lands hardest on precisely the demographic that both the tax structure and the equity wealth mechanism are leaving furthest behind. The counter-dynamic is that some oil-related equities and defense names have outperformed. The S&P 500's top performers this month have mostly been energy and defense, but that rally benefits portfolio holders, not workers. The labor market is processing a separate but related structural shift driven by AI adoption, and the mechanism is compressing the time horizon for professional relevance. Harvey, the AI legal startup now valued at $11 billion with backing from OpenAI, Sequoia, and Kleiner Perkins, has institutionalized this pressure. CEO Winston Weinberg requires every employee, including himself, to re-earn their role every 6 months. The logic is that in a compounding innovation environment, The cost of falling behind is not incremental but existential. Duolingo has operationalized a similar threshold, with CEO Luis von Ahn having replaced contract workers with AI starting in April 2025, and now evaluating candidates through covert behavioral tests before formal interviews begin. Indeed's 2025 Tech Talent Report shows tech job postings are down 36% from pre-2020 levels, while more than 40,000 tech workers have been laid off so far this year. The structural consequence is that AI is simultaneously eliminating entry-level positions and raising the behavioral and adaptability bar for those that remain. A scissor effect that narrows the pipeline into the professional workforce, at exactly the moment when lower-income households most need it to remain open. 3 watchpoints now determine the trajectory of these linked chains. First, the Strait of Hormuz. If the shipping lane reopens within weeks, oil's inflation pass-through to mortgages and food prices can be contained. If the blockade extends past June, the IGD's 8% food inflation projection for the UK becomes a floor, not a ceiling, and the Fed's stagflation dilemma deepens. Second, the peace talk signal from Washington. Trump's announcement moved markets by $1.7 trillion in a single session, but Iran's foreign minister denied that formal negotiations had begun. A confirmed diplomatic channel would reset Treasury yields and mortgage rates faster than any Fed action, while a collapse of talks pushes Brent back toward the $120 per barrel level that MarketWatch analysts have identified as the tipping point, where the Fed's attention shifts definitively from inflation to recession risk. Third, AI-driven labor displacement. If leading firms continue replacing contract roles with AI at the pace Duolingo and others have signaled, the unemployment data that typically anchors Fed rate decisions will begin to diverge from the true employment picture, making the Fed's information set less reliable at precisely the moment when its policy choices carry the highest stakes.